Hi there, welcome to Kneppy Invests. I'm going to do a video on a company I know a little bit about, and that's Steadfast, which is an insurance broking company. Now, even though I know what they do, I haven't gone into too much depth in my research on this company in the past because I'm not that enamored in the insurance business or sector. Now, as I did a little bit more research, I came to the understanding or realization that Steadfast is an acquirer or an aggregator of other insurance brokers. So, probably the best way to put this, and this is how they describe themselves as, they are an insurance broking network. So, you might define this company as, or the business model as, a roll-up business model. Get as many insurance brokers as possible. Now, that makes me a little bit more wary about this company because that roll-up model can be successful in the short to medium term, but eventually that business model will come under pressure. We have seen that happen a lot in the past. So even though right now Steadfast is being successful in their business model, I think there will come a time in the future where they will find that that business model just won't work. I have no idea when that will be. It could be next week. It could be in 1 year from now. Could be even 10 years from now, because this company is expanding overseas. And in fact, I'm going to show you an example of a roll-up model. And the problem with comparing Steadfast to my example, which is G8 Education. G8 Education was simply Australian-based, maybe even New Zealand, but Australian-based, while Steadfast looks like they could be heading to becoming a global insurance broking, networking sort of company. Now, first thing I want to do or talk about when I first start researching a company, I just want to try to get an understanding about the quality of the company. And just based off the chart and the revenue growth, I probably would say that Steadfast is a high quality company. So for high quality companies, it's all about value. Is there any value in the company right now, or do I have to pay a premium for the company? So that will be the main talking point when I'm talking about Steadfast. Also have a look at the share price trend, looking at the weekly trend and also the daily trend in 2 slides during this video. But I'm mostly concerned with the value of this company. For full disclosure purposes, I am not a shareholder of this company, and I have never thought about buying or taking a position in this company in the past. One of the reasons I'm doing a video on this company is just to share ideas with viewers of this channel. So just because Steadfast might not be intriguing to me, may not be a suitable investment in my portfolio, doesn't mean it's not a possible candidate in your portfolio. So I just like to share ideas. And a lot of the ideas I do share are the sort of companies I probably won't invest in the future. Steadfast more than likely won't be that sort of company that I will invest in, but you never know. So I always like to do a little bit of research on most companies. Now, in saying all that, Steadfast has been remarkably successful since it's listed on the ASX. Well, not since it listed, because it listed on the ASX in 2013. And from when it listed in 2013 all the way through to 2016, so for about 3-year period, share price of this company just went sideways. You can see that long period of time when the share price did absolutely nothing. So maybe the market, the ASX, wanted to see if this business model would work. And then the share price broke out in the middle of 2016. You can actually see 1 week with very large volume. So this is a weekly chart. So there's 1 week with very large volume, and that coincided with the breakout. And ever since then, the share price has been increasing. Now, of course, the share price doesn't go up in a straight line. And whenever we see a little bit of weakness in the share price, whenever the share price falls either just on the 100-week moving average or just below the 100-week moving average, that is the time to take a position in this company if you like Steadfast and you like their business model and you think this company has a future. We have seen this play out about 7 times in the past: 2018, 2019, 2020, twice in 2020, and again twice in 2022, where we have seen the share price reach those buying levels just based off the technicals here. And the most recent time was about 4 to 5 weeks ago when the share price actually bounced off the 100-week moving average. The only time it has fallen significantly below that moving average was way back during the COVID-19 financial panic, which is absolutely understandable. But then the V-shaped recovery in the share price pulled the share price back above the 2 moving average fairly quickly. So this is another reason why I probably would call Steadfast a high quality company, simply because this is the chart you'd like to see for all high quality companies. Share price going from the bottom left to the top right. Now to the financial year 22 results for the company. Now at a share price of $5.05, and I am recording this video about 1 hour before trading has ceased on the 9th of November. The share price was around that level. So of course, if you are watching this video after the 9th of November, have a look at the share price. If the share price is significantly lower than $5.05, the market cap will be significantly lower than $5.2 billion. But this company does have about 1 billion shares on issue, and that means the market cap of the company is, of course, $5.2 billion, which is 1 billion times $5. Now, another thing to understand with Steadfast, because this company is an acquirer or an aggregator of other insurance brokers, one of the ways they do fund the acquisition of these companies or these brokers is by issuing shares. So the shares on issue for this company have been increasing since they listed on the ASX. In fact, shares on issue have more than doubled over the past 9 years. So you always have to take that into account when you're talking about this company. Now, onto the financial year 22 results. Revenue 1.14 billion, profit 169 million, and the operating cash flow and the free cash flow quite a bit higher than the profit. So the operating cash flow 234 million and the free cash flow 230 million. And another reason I'd probably define Steadfast as a high quality company is the revenue growth. We are seeing consistent revenue growth with this company. And the other thing I've included here is just gross margins. And we've also seen gross margins increase from 2016. Now, because this company is a acquirer of other businesses, because they do issue shares, just looking at the revenue growth is not good enough. I would ideally like to look at revenue per share growth, and you can get that sort of information online in places. And I've taken this data from Guru Focus. In fact, the chart is from Ticker, but the revenue per share growth is from Guru Focus. They do provide this sort of information. So if we do look at the revenue per share growth, this company has been increasing at 12.4% since over the last 8 years, 12.1% over the last 5 years, and 9.1% over the last 3 years. So this company is growing. And the majority of the growth this company has seen has been greater than 10% per year. And this is one of the things I am looking for in an investable, well, I say a long-term investable company or high-quality company. Now, I've already mentioned this company has increased or doubled their shares on issue since they listed on the ASX. So the shares on issue have increased from 479 million to actually over 1 billion. That $961 million was at the end of last financial year, and shares on issue have increased further. Now, this company have made a couple of big acquisitions in the past year. Have a look at their financial year 22 presentation, and they go through a lot of the numbers in relation to these acquisitions, and they say these acquisitions are earnings per share accretive. Always take when a company says an acquisition is EPS, earnings per share accretive, I always look at that with a grain of salt because it doesn't always happen. The other thing you have to keep in mind as well when a company is highly acquisitive, just like Steadfast, is research has shown that in the majority of cases, acquisitions are not beneficial to shareholders. And this is even truer for bigger companies. It's actually less true for smaller companies. So for smaller cap companies, acquisitions actually do tend to benefit us shareholders. But when you're talking about really, really large companies, acquisitions tend to be harmful for the value of the company and for shareholders of the company. So they are not earnings per share accretive in the short to medium term. Now, because Steadfast is an acquirer of other insurance brokers, it's very important to get a breakdown of their growth. Are they only growing because of acquisitions and there's no organic growth at all? And thankfully, the company did provide this information in their financial year 22 presentation. And this company is growing organically. In fact, the majority of their growth in terms of earnings per share and profit was organic. 11.3% in financial year 22 and 5.2% acquisition growth. So the main thing here is this company is growing organically. And if they didn't or don't make any acquisitions, it does not mean the company won't grow. So that's the most important thing here, is this company is growing organically and not just through acquisitions. Now onto the valuation of Steadfast. And this might be the most important slide, because then in this slide we find out whether there's any really good value for this company right now. So the P/E ratio of Steadfast is 30.8. Now, in isolation, that tells us nothing. Is that higher than usual for this company or lower than usual for this company? And I'll talk about that in the next slide, or a few slides from here. So 30.8 might seem a little bit high, but of course, this company has been growing their earnings per share and their revenue at a pretty consistent rate over the past 9 years. Price to sales ratio 4.6, price to operating cash flow 22.2. So that is a little bit high, but it's not absurdly high. And I also did a reverse DCF. How would this company have to grow I think I used free cash flow for this particular metric. How would their free cash flow have to grow to justify their current valuation? And that's only 13.5% per year, which doesn't seem too high. And I think Steadfast could achieve that number. Now, I'm just saying they could achieve, but maybe you would like a bit of a margin of safety, and maybe that reverse DCF would be, say, 3.5%. And if you saw, or if you calculated reverse DCF and you got a number of 3.5%, that's when you might say, well, I definitely think that this company can achieve that. And that's when you see some good value in this company. So I think this company right now might be fairly valued. I don't think it's undervalued. Probably don't think it's overvalued just based off these raw numbers. Now, looking at those valuation metrics in isolation really tell us nothing about whether a company might be undervalued or overvalued. You might have your suspicions, but one of the things I do like to do is just look at those valuation metrics and compare it to historical ranges for a company. So this is the price to free cash flow for Steadfast since 2014. So we can just see whether the company is overvalued or undervalued just off this one valuation metrics compared to historical ranges. And again, I think right now it's fairly valued. So it's sort of in the middle range between the top and the bottom. So if we look at the bottom here, and when you could argue that this company was really good value was back in 2016. And remember, from when this company listed to the middle of 2016, share price of this company just went sideways. So obviously the company was growing for those 3 years, but the market hadn't come to a realization that, or they hadn't discovered this company at that point in time. And then the market discovered this company during 2016. And that's why the price to operating, or the price to free cash flow, went from its lowest point to its highest point, or within about 1 year and about 4 or 5 months. The other time we did see some pretty good value with Steadfast, of course, was during the COVID-19 financial panic, when the price to free cash flow of this company actually went down to less than 9. Now, at the peak of the hype in this company was back in 2017, when the share price started its run up, when it broke out, say about 10 months after it broke out, and the price of free cash flow of Steadfast actually rose to about 29. The other time we saw the peak in the price to free cash flow was back in the start of 2022, when the price of free cash flow reached 26. So right now, at around 22 is sort of in the mid-range between the top and the bottom. And again, I think this company is fairly valued right now. Now, one of the other things I like to see when a company does release their financial year 22 or whatever it is, year's results, or when a company does an AGM, is any sort of guidance. And Steadfast have released some financial year 23 guidance, and there are quite a few assumptions here. So the likelihood of all these assumptions coming true is probably unlikely. But anyway, underlying EBITDA between 400 and 420 million, underlying NPAT between 190 and 202 million, and underlying diluted earnings per share growth between 5 and 11%. And majority of that growth looks like it will be organic. not because of acquisitions. And some of the key assumptions are strategic partners, continued premium price increases, completion of Insurance Brands Australia acquisition. So that's one of their major acquisitions they have made, an equity raising, $250 million equity raising, and no material economic impacts from current global uncertainties, which might be a hard assumption to keep hold of because they have no say on that particular assumption. So I think keep an eye on any sort of updated guidance this company does release. I'm not sure if Steadfast will be affected by any economic, macroeconomic impacts. I think there's a probably chance they won't be as infected because I'm just assuming here that insurance isn't something that people will drop if they do come under financial hardships. I could be completely mistaken, but I think these are sort of some of the products that people just won't get rid of if they are starting to feel poorer or they've lost their job, that sort of thing. Now, I've already mentioned that I'm a little bit wary of roll-up models. So roll-up models are companies that just acquire. So for instance, Steadfast is an insurance broker networking company, and they just acquire other insurance broking companies and they just roll them up together into the one business. So a perfect example of a roll-up business in the past was G8 Education. So this was childcare centres. And there's only so many childcare centres in Australia. But from about the later period of 2011 all the way through to 2014, this was a really big success story on the ASX. In fact, the share price increased from 50 cents to over $5. So this was a 10-bagger over a 3-year period, and this was during their roll-up phase. Now, one of the problems with the roll-up phase is once you start getting to the end of your acquisition spree, you'll start to see that a company like G8 Education will have to pay more and more of a cost to acquire additional daycare centres. And I think at that point, when you come to the realization that what they're paying for is probably a little bit too expensive, I think that is the end of that business model. And that's why we have seen a share price of G8 Education fall from a high of $5.20 all the way back down to below $1. So right now, this is more of an income company. They do have a nice dividend. I think they issue a dividend maybe every 3 months or something like that. And you should see the share price just going sideways since COVID-19 financial panic. So again, there is problems with the roll-up model. Eventually, there's no more other companies to acquire. And if they are, more than likely, you will have to overpay for them. Now, in saying all that, it's probably a little bit harsh on Steadfast to compare this company to G8 Education, simply because Steadfast is expanding overseas and this roll-up model could continue for over a decade from here. So let's have a look at the daily chart here. Now, because I'm more interested in the value, not really interested in the trend of the share price, this is of less interest to me, but it is interesting the share price of Steadfast right now and over the past year is just going sideways. In fact, the share price has barely increased over the past year. Share price has been as high as $5.50 and as low as $4.30. It's just been trading in between those two levels. And if you just look at those two moving averages, we've seen numerous crossovers in those two moving averages, which I think is the 50-day and the 100-day moving average. And when you do see a lot of crossovers like we see here with the moving averages, that is telling you the share price is just going sideways. So right now, the share price of Steadfast is not in an uptrend, nor is it in a downtrend. I plan on doing or continuing this video series for quite a while yet. And the next 5 companies I will be featuring in this series include Objective, Credit Corp Group, Australian Clinical Labs, Request, SRG Global, and I thought, why the hell not? Let's do Myer, because share price was running up. For some reason, the market is right now interested in this company, even though revenue has been falling consistently over the past 5 to 10 years. So I thought maybe there is a possible investment. Maybe Myer is turning their company around, whoever the CEO is. So I thought, let's have a look at Myer. I haven't had a look at Myer for quite a few years. If you do have any suggestions, preferably companies that have a profit, have revenue, and are growing their revenue. But that's not a necessary requirement because I have included Myer in this group and they're not sort of company that you would describe as growing. So just leave any suggestion in the comment part of this video. That's all I have for this video, looking at Steadfast and their financial year 22 results. If you have any thoughts, any comments, any questions about Steadfast, if maybe I've mentioned something that's completely wrong, I'd love to hear about it, because I am only human and I do make mistakes, and I haven't looked much into this company. So maybe calling them an aggregator or acquirer of other insurance brokers is completely wrong, but that's the story I got from reading their presentation, going to their website. Anyway, so leave anything you have to say in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.